Dear learners, welcome to my channel, Educare Horizon. In this video, we are going to discuss accounting. Accounting is the language of business. The basic function of language is to serve as a means of communication. So accounting is the language that managers use to communicate the firm's financial economic information to the external parties such as shareholders, creditors, government, etc. In this context, the purpose of accounting is to communicate or report the results of the business operations and its various aspects. So as a layman definition, we can say accounting is the language of business. Man expresses his feelings through language in written and verbal form. Similarly, various information of the business organization are expressed and presented through accounting statements. So accounting is just like a language like English. The ultimate objective of any language is to serve as a means of communication. So in that context, we can say accounting is also a language, or it is a medium of exchange of communication between the management and its various parties of accounting information. In order to handle any languages in the world, we should possess the following skills: reading skills, writing, listening, and speaking skills. For example, English language learners should learn and practice phonics, vocabulary, grammar, reading fluency, including oral reading skills, reading comprehension strategies. Similarly, practicing the language of business requires at a minimum understanding of the fundamentals like accounting principles, concepts, and conventions, journalizing, posting, balancing, preparation of trial balance, the balance sheet, the income statement, cash flow statement, etc. are required. So accounting is a language. It serves as a means of communication between the management and its varied uses of accounting information like shareholders, investors, government, creditors, bankers, etc. So just like a medium of exchange as a language, in order to communicate effectively in language, see, the learners are required to learn vocabulary, phonics, grammar, reading fluency is required, and comprehension strategies are required. Just like English language, in business accounting also, so we are required to practice various fundamentals like accounting principles, concepts, conventions, generalizing, posting, balancing, preparation of trial balance, preparation of balance sheet, preparation of income statement like profit and loss account and balance sheet, and the cash flow statement or fund flow statement. So in order to interpret the financial statements, see, we are required to learn all these accounting principles and all the procedures like generalizing till preparation of income statement. So this context, the purpose of accounting is to communicate or report the results of business operations and its various aspects to the varied interested parties of accounting information. According to UG, as the language of business, accounting has main things in common with other languages. The various business activities of a firm are reported in accounting statements using accounting language, just as news events are reported in newspapers in English or another language. As a language of business, accounting is the language or the common medium of language. The various business activities of a firm are reported in accounting statements like trading account, profit and loss account, and balance sheets, and various statements using accounting language, just as a news event are reported in newspaper. In order to report a news event in newspapers, so we are required to use some common medium of exchange. We can say language, maybe English, it may be Hindi or Malayalam or whatever it may be the language. And some formats also it should be there, commonly accepted formats also should be there. So just as news events are reported in newspaper in English or other language, in business, the communication we used to pass through accounting language. The next one we will discuss the evolution of accounting. Accounting is as old as money itself. However, the act of accounting was not developed as it is today because the early stages of civilization, the number of transactions to be recorded were so small that each businessman was able to record and check for himself all his transactions. So as far as evolution of business accounting is concerned, we can say accounting is as old as money itself. So whenever see money as a common medium of exchange accepted, we can say accounting was also started. However, in the ancient periods of civilization, the volume of transaction, the natural transactions to be recorded, the volume of transactions to be recorded are very small, and the businessman was able to record and check for himself all the transactions. Even he can remember all the transactions. That is why the scope of accounting was very less during the ancient or early stages of civilization. And as the scale of operations enlarged from small scale to large scale, the volume of transactions increased, and it is very difficult to remember each and every transactions. So See, later on, you can see the systematic maintenance of accounts started. See, accounting was practiced in ancient period itself. There are a lot of references showing that, see, accounting was practiced at the stage of Vedic and even pre-Vedic period. Accounting was practiced in India 23 centuries ago, as is clear from the book named Arthashastra, written by Kaudilya, King Chandragupta Maurya's minister. The pre-Vedic and Vedic literatures contain numerous references which indicate that accountancy existed in somewhat developed form in ancient India. In Valmiki's Ramayana, Ayodhya Kanda Sarga 100, Rama asked Bharata when the latter met him in the forest, is your income more than your expenditure and your expenditure less than your income? In Mahabharata, King Yudhishthira ordered his brother Nagula to look after the army's accounts. Shanti Parva Sarga 40. In the classic work Arthashastra, Kaudilya gave detailed instructions regarding accounting and auditing of the state finances. According to him, all undertakings depends on finance. Hence, foremost attention shall be paid to the treasury. So all these references showing that accounting was practiced even the Vedic and pre-Vedic period itself. See, lot of references in Arthashastra, Kaudilya's Arthashastra, lot of references are there showing that accounting and financial management was practiced or evolved during his period itself. See, one example in Valmiki's Ramayana, Ayodhya Kanda Sarga 100. When Rama met his brother Bharata in the forest, he is asking a question regarding the treasury management of Ayodhya. Is your income more than your expenditure or otherwise? So Rama is asking a question whether income of Ayodhya is more than the expenditure or expenditure is more than income. So in this case, Bharata, suppose he answered income is more than expenditure or expenditure is more than income. He can't answer such a question without accounting. Similarly, in Mahabharata, another classical work, King Yudhishthira ordered his brother Nagula to look after the books of accounts of army. So in this case, Yudhishthira, the elder brother of Pandava, ordered his brother Nagula to look after the books of accounts of army. Look after the books of accounts means inspection of the books of accounts. Inspection of books of accounts is something more than that of accounting. See, technically we can say it is auditing. See, we used to say auditing begins when accountancy ends. So this indicates that accounting and auditing was practiced during the period of Vedic and pre-Vedic period itself. See, in the classical work Arthashastra, Kaudilya gave detailed instructions about treasury management. According to Kaudilya, all undertakings depends on finance. See, finance is the lifeblood of any economic activity. Without finance, no economic activity can carry on. So hence, according to Kaudilya, foremost attention shall be paid to the treasury management, financial management. Financial management. In financial management, Kaudilya's Arthashastra will be treated as the classical work in financial management. Then we will discuss definition of accounting. The main purpose of accounting is to ascertain profit or loss during a specific period, to show financial conditions of the business on a particular date, and to have a statement over the firm's property. So the ultimate objective of accounting is to determine the profit or loss. We can say operating result of the business enterprise during a given period of time, usually a year. And also to show the financial position, the assets and liabilities position, the financial position of the company on a particular date. Accounting is a discipline which records, classifies, summarizes, and interprets financial information about the activities of the concern so that intelligent decisions can be made about the concern. So accounting is a discipline, consists of various functions like recording, classifying, summarizing, and interpreting financial information about the activities of the concern, so the user is in a position to make intelligent decisions. So we will discuss the definition given by AICPA according to American Institute of Certified Public Accountants, AICPA, in 1941. Accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money transactions and events, which in part at least of financial character, and interpreting the results thereof. So this is the most important definition for accounting given by American Institute of Certified Public Accountants, AICPA, the Chartered Accountancy Institute or organization from America, CPA. See, according to them, accounting is an art of recording, classifying, and summarizing in a significant manner and in terms of money transactions and events which impart at least a financial character and interpreting the results thereof. So if we observe this definition, we can see that there are 3 or 4 points will be there. Accounting is an art. First one is accounting is an art. Second one, recording, classifying, and summarizing. Third one is in a significant manner in terms of financial character or money transactions. And last one is interpreting the results thereof. So accounting is an art. Accounting consists of recording, classifying, and summarizing money transactions or transactions which are at least of financial character. And the last one, interpretation of the results thereof. The second definition that is given by American Accounting Association, AAA. According to American Accounting Association, accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by the users of information. According to American Accounting Association, accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by the users of accounting information. This is more or less similar to the AICPA's definition. If you observe, you can see that it's a process of identifying, measuring, and communicating. So in order to identify and in order to measure, we require all the processes like recording, classifying, and summarizing. communicating economic information. We can say, see, money transactions. Economic transactions means here we can say money transactions or transactions which are at least of financial character, to permit informed judgments and decisions by the users of accounting information. That means interpretation of the financial statements. So these are the two important definitions. One is given by AICPA, the second one is American Accounting Association. The next one we will discuss, which are the or who are the users of accounting information. The users of accounting information we can broadly divide it into two: internal users and second one is external users. Internal users we can say the management or the managers itself, the people who are within the organization. We can say the managers. In order to take decisions, see, managers are required to refer the accounting information. Then external parties, external users consist of shareholders, investors, creditors, government, then bankers. So see, we can say external users are those people who are outside the business organization, and many people will be there. See, the following are the some of the examples of external users. We can say shareholders, they require accounting information. Then investors, they require accounting information to decide whether to invest in such a business organization or not. Creditors require accounting information. Bankers require accounting information in order to take decision whether to grant a loan or not. Government require accounting information to see levy taxes. So these are, see, in addition to that, many other see external users are there, including the public. So these are the uses of accounting information. The next one we will discuss, which are the branches of accounting. So there are three branches of accounting. First one is financial accounting, second one is cost accounting, and third one is management accounting. In some textbooks, see, maybe you can see only two branches. That is, first one is financial accounting and second one is cost and management accounting. Cost accounting and management accounting will be comprised into single branch of accounting called as cost and management accounting. So what are the functions of financial accounting? The ultimate objective of financial accounting is to determine the profitability and the financial position of the organization, and see, communicate it into the see external uses of accounting information. Cost accounting or cost accounting and management accounting are concerned with the provision of information within the organization. The main purpose of financial accounting is to record business transactions in the books of accounts in such a way that operating results for a particular period and financial conditions on a particular date. Cost accounting, that is related to the collection, classification, ascertainment of cost and its accounting, cost control relating to various elements of cost. As far as management accounting is concerned, it relates to the use of accounting data collected with the help of financial accounting and cost accounting for the purpose of policy formulation, planning, control, and decision making by the management. See, as far as the three branches are concerned, the first branch of accounting, the first evolved branch is financial accounting. So financial accounting ultimate objective is to record, classify, and summarize transactions to determine the operating result and see the financial position or financial condition of the business on a particular date. Later on, during the Second World War, whenever the resources are scarce, see, the accountants or the people found that see, financial accounting is not sufficient for utilizing the resources, the scarce resources in an optimum manner. So that then the second form of see accounting world, that is cost accounting. The cost accounting is it consists of or it relates to the collection, classification, ascertainment of cost, its accounting, cost control relating to various elements of cost. So during the Second World War, see, there was scarcity of resources, and see, our ultimate objective was to utilize the resources in an optimum manner. See, that is why See, cost awareness, cost elements, see, cost reduction, cost control awareness evolved during those days. See, not only cost accounting, see, many other disciplines like operations research, operations management are also evolved during the Second World War time, including cost accounting. See, all these techniques like operations research techniques are also we are using for cost reduction and cost control, like see linear programming problems, see PERT, program evaluation and review technique, etc. Then third form of business accounting, that is management accounting. It relates to the use of accounting data collected with the help of financial and cost accounting for the purpose of policy formulation, planning, control, and decision making by the management. So the third form of accounting, it was evolved during 1980s. So as far as management accounting is concerned, as compared to other two forms of accounting, management accounting will be treated as a recent origin. The ultimate objective is to help the top level management in policy formulation, planning, control, and decision making. So that is why the position of management accountant will be at the top level immediately after the general manager or CEO. Then we will discuss the double entry system. The financial accounting, we discuss the first evolved accounting branch is financial accounting. Accounting was evolved or practiced even during the pre-Vedic period itself, or whenever people started their civilization. Or see, money evolved. But the modern or the systematic or scientific or modern system of accounting that commenced only after the evolution of double entry system. Before the evolution of double entry system, accounting was practiced, but that was only in a crude form. There was no systematic or scientific maintenance of books of accounts. So the modern system of accounting, based on the principles of double entry system, owes its origin to Luca Pacioli, who first published the principles of double entry system in 1494 at Venice in Italy. So the modern system accounting was evolved by Luca Pacioli in 1494. He evolved the double entry system, double entry principle and double entry system in 1494. That is why Luca Pacioli will be treated as the father of accounting. Thus, the art of accounting has been practiced for centuries, but it is only in the late 30s that the study of the subject of accounting has been taken up seriously. According to Luca Pacioli, there are two aspects in every business transaction. One is the receiving aspect, and the second one is the giving aspect. So according to Luca Pacioli, there are two aspects in every type of business transactions. One is receiving aspect and another one is giving aspect. According to him, the receiving aspect will be denoted as debit, and the giving aspect will be denoted as credit. It will be denoted in short form. Debit will be we used to denote DR, and credit will be denoted as CR. Debit in short form we used to use in accounting DR, and credit will be short form we can say CR. Then we will discuss what are the factors of business. There are three types or factors common in every business. First one is personal account, second one real account, and third one is nominal account. So we'll discuss what is personal account. Transactions related to persons are called as personal account, and transactions related to assets are denoted as real account. Transactions related to expenses, incomes, gains and losses are called as nominal account. The business has to enter into business dealings with a number of persons or firms. An account of each person or firm with whom the business dealings is opened, such accounts are called as personal accounts. So in order to transact economic activity, business is required to enter into number of transactions with many number of persons. So the transactions related to persons are called as personal accounts. The second one is real account. The business must necessarily have some assets such as stock, cash, furniture, etc., with the help of which the business may carry on. Therefore, an account of each assets in the business is opened. Such accounts are called as real or property accounts. So we can say the transactions which are related to assets or property are called as real account. So in order to carry on our business transactions, we require many kinds of assets like land, building, furniture, like that of cash, stock, etc. is required. So the each and every transactions or type of assets we are required to open separate account. So the transactions related to assets are called as real accounts or property accounts. The last one is nominal account. So there must be sources from which the income of the business is derived. Similarly, certain expenses must be incurred to earn the income. Therefore, an account of each expenses and income is opened. So the transactions related to expenses, losses, incomes and gains and such accounts are called as nominal or fictitious accounts. So these are the, according to Luca Pacioli, these are the common types of business transactions or factors in business. First one is personal. Transactions related to persons are called as personal account. So we are required to open each and every person separate account. So that is called as personal account. The second one is real account. In order to carry on business transaction, the business require many assets like land, building, cash, stock, furniture, etc. Each and every assets we are required to open separate account. See, that account is called as real account or property account. The third one is nominal account. So this is related to expenses, incomes, gains and losses. So transactions related to expenses, incomes, losses and gains are called as nominal or fictitious accounts. See, Luca Pacioli gave a detailed rules of double entry. That means in order to determine which aspect to be debited and which aspect to be credited. See, for each and every transactions like personal account, real account and nominal account, he gave detailed rules of double entry. So this is very, very important, rules of double entry. This is the base of financial accounting. First one is double entry rule, principle or rule for personal accounts. The double entry rule is that debit to the receiver and credit to the giver. Debit to the receiver and credit to the giver. Then second one is real account. Real account, we can say that is related to assets. The double entry principle is that debit what comes in and credit what goes out. And third one is nominal account. These are transactions related to expenses, losses, incomes and gains. The double entry principle, you can see here, debit all expenses and losses and credit all incomes and gains. So these are the double entry principle evolved by Luca Pacioli. That will be the base of financial accounting. See, personal account rule, debit the receiver and credit the giver. See, as per this principle, receiver will be debited and giver will be credited. The second one is real account. This is transactions related to assets. The double entry principle is debit what comes in and credit what goes out. So whatever assets comes in into the business, that will be debited, and whatever assets goes out or going out, that will be credited. And the third one is nominal account. See, these are, remember, these are transactions related to expenses, losses, incomes, and gains. The double entry principle is that debit all expenses and losses and credit all incomes and gains. That means, see, expenses and losses will be debited, and see, whatever incomes and gains of the business will be credited. So these are the, see, rules of double entry. Then we will discuss what will be the accounting process or accounting procedure. See, accounting we discuss, it is an art of recording, classifying, and summarizing. So accounting is a process. It is a step-by-step process. It consists of many elements. It consists of many steps. So we will discuss what are the steps involved in accounting process. So it consists of 5 steps. First one is recording. For the purpose of recording transactions, all the transactions will be recorded into a common book, whether it is related to assets or it is related to expenses or incomes or person, irrespective of the fact that, see, which head it will come. See, we are required to record transactions into the books of account. That is called as journalizing. So we are required to open, we are required to provide journal book. So the first step is maintenance of journal book or subsidiary books. See, that is for the purpose of recording transactions into books of accounts. See, after recording transactions into the books of accounts, see, we are required to classify. See, the first step, see, maintenance of journal book for the purpose of recording transaction. In journal, we used to record all transactions. But later on, see, we are required to segregate. The common transactions will be separated and it will be recorded separate for the purpose of, balancing and for the purpose of summarizing. So for that purpose, we are required to perform another function that is called as classifying. See, for the purpose of classifying transactions, we are required to maintain ledger accounts. So the second step is maintenance of ledger accounts or posting into ledger accounts. Those transactions which are recorded in journal book, see, that is called as books of original entry. That will be periodically, it will be segregated or classified and it will be recorded into separate ledger accounts. Then third function, at the end of the accounting period, see, we are required to prepare the trial balance and summarizing. We are required to prepare the income and income statements and balance sheet. So we are required to know what will be the net effect of each and every opened ledger account. So for that purpose, we are required to balancing of accounts. So third step is balancing of accounts. Then the fourth step is preparation of trial balance. So from the extracted figures of ledger accounts, we are required to prepare a statement that is called as trial balance. And fifth one is summarizing. In order to determine the profit or loss situation for the entire period, or in order to determine the operating result, we are required to prepare income statement consisting of trading account and P&L account. And similarly, we are required to know the financial position. For that purpose, we are required to prepare another statement called as balance sheet. So shortly called as final accounts. So these are the steps involved. So we can say journalizing or maintenance of journal book, then posting into ledger accounts, balancing of accounts, preparation of trial balance, and preparation of final accounts consisting of income statement and personal statement. So let us discuss one by one in detail. The various steps involved in accounting process. First one is journal or subsidiary. Journal is derived from the French word jour, which means a day. Journal therefore means a daily record of business transactions. Journal is a book of original entry because transactions firstly written in the journal from which it is posted to the ledger at any convenient time. The process of recording transaction in the journal is called journalizing, and the form in which it is recorded is called as journal entry. So we can say the word journal is derived from the French word jour, which means a day. Therefore, we can say journal is the record of daily business transactions. So that means, see, we are required to record, the bookkeeper or the accountant is required to record all the transactions into the journal book or in a chronological order. The time wise and date wise, we are required to record all the transactions into the journal book, irrespective of any kind of classification. That is why journal will be treated as the book of original entry, because transactions are initially recorded in the journal form, and later on, periodically, see, we are required to transfer into ledger accounts. So journal book will be treated as the book of original entry. If there is any doubt, journal will be the base, because we are, see, that will be treated as the base of, see, accounting, because see, we used to record transactions, daily transactions in a chronologically, time wise, we used to record transactions into the journal book without any classification. The process of recording a transaction in the journal is called as journalizing, and the form in which it is recorded is called as journal entry. So whenever we are writing or entering transactions in the journal book, that process is called as journalizing, and the form in which form we are entering into the journal book, it is called as journal entry. So this is the format of a journal book. Date column will be there, then particulars column, LF represents ledger folio, then debit amount column and credit amount column. So this is the structure. First one is date, so we used to record the date of the transaction. Then particulars column, this is the main text of the journal book, so we used to record journal entry in the particulars column, including narration. Narration means the short description of the transaction. So after entering journal entries in the journal book, we are required to provide a narration. Narration means the short description of the transaction. So a journal entry without narration is incomplete. The next one is ledger folio. This is the ledger account page number references, and next two columns, debit amount and credit amount. So we used to record debit amount and credit amount. The next one is ledger accounts. After maintenance of journal, see, periodically we are required to transfer or segregate or classify transactions into the ledger accounts. So in order to consolidate the transactions recorded in the journal, the transactions of similar nature are recorded in a particular form called the ledger. Therefore, a ledger account is a summary statement of all the transactions relating to a person, asset, expense, or income which have taken place during a given period of time and shows their net result. So after generalizing periodically as a part of classifying the common transactions or similar transactions, we are required to transfer it into a separate account, a separate statement. It is called as a ledger account as a part of consolidation, as a part of preparation of summary account. See, the common transactions, similar transactions of assets or person or expense or incomes. For example, we can say all the transactions related to Mr. X, that will be recorded in a separate account. All the transactions related to an asset like machinery, that will be recorded into a machinery account. All the transactions related to we can say expenses, that will be recorded into a separate account. See, as a part of summarizing, as a part of consolidation, so we are required to periodically we are required to transfer transactions from the journal to the ledger. The process of transferring a transaction from the journal to the ledger is called as posting. So suppose we are entering any transactions to ledger accounts, that process is called as posting. So with the help of posting, we are in a position to classify transactions of similar nature. So this is a format of a ledger account. See, you can see left hand side is debit and right hand side is credit. The debit side consists of date column, particulars column, JF represents journal folio, then amount. Then other see section like similar to debit, you can see credit side also debit, particulars, JF and amount. In order to segregate this debit side and credit side, you can see one thick line or double line will be there. So debit side consists of date, particulars, JF, amount, and credit side consists of date, same like the debit side, date, particulars, JF, and amount. Then after entering transactions into the ledger accounts, at the end of the accounting period, in order to determine the net effect, either debit or credit, so we are required to balance the various accounts already opened. So third function is balancing of accounts. So various accounts are balanced with a view to preparing the final accounts. This is as a part of preparing final accounts. But just before preparing the final accounts, the fourth process is there, and is preparation of trial balance. So we are required to prepare a statement from the extracted figures of ledger accounts. We are required to prepare a statement to determine the arithmetical accuracy of the books of accounts. That statement is called as trial balance. So in order to know the arithmetical accuracy of the books of accounts, or to know the compliance of the dual aspect concept, we have to prepare a statement called as trial balance. In this statement, balances of the various accounts are entered, and this statement act as a base for the preparation of finalization of accounts. So the ultimate objective of preparation of trial balance is to determine the arithmetical accuracy of the books of accounts or the compliance of dual aspect concept. As per dual aspect, every debit is having a corresponding credit. That means suppose we are giving debit of rupees 10,000, there will be an equivalent credit of rupees 10,000. Suppose there is any deviation in this rule, we can say that that system is not complying the double entry principle, and we cannot go ahead like preparation of final accounts. So just before the preparation of final accounts, we are required to ensure that our books of accounts are correctly maintained. or if there is any errors and frauds, see, we are in a position to identify with the help of trial balance. If there is any disagreement between the debit and credit, so we can say some errors are there. So see, we are required to rectify such errors and see, prepare the final accounts. Then this is a format of a trial balance. See, please remember the title. It will be like this: trial balance for the year entered or year ending such and such date. See, serial number, first column is serial number, the name of account, debit amount and credit amount. So serial number we have to record. The next one is name of account, name of the ledger account. And suppose that ledger account is debit balance, it will be under the debit column. In case an account, a ledger account is showing credit balance, it will be entered on the credit side. So like that, each and every account, debit or credit balance should be recorded, and finally we are required to add debit side and credit side, and that figures must tally. That means debit and credit amount must be equal. If there is any disagreement, suppose it is not tallying, that means some errors are there. So as an accountant, we are required to see, rectify such errors and then prepare the final accounts. Then last step after the preparation of trial balance, after ensuring that our books of account double entry system is duly complying, it is accurate, then we can go ahead like preparation of final accounts. Final accounts consists of two statements. First one is income statement. Income statement consists of two: trading account and P&L account. And second statement we can say balance sheet. The preparation of final account is the last step coming under the consolidation of accounts in financial accounting. The final accounts consists of trading and profit and loss account and balance sheet. The trading and P&L account shortly called as income statement, and balance sheet we can say position statement. So first one is trading account. Trading account gives the trading result of the enterprise by way of buying and selling or manufacturing and selling. So what will be the profit? That gross result we are in a position to identify with the help of trading account. The P&L account shows the net profit or operating profit during a particular year. See that P&L account provides the net profit or operating profit of the enterprise that we used to set up all other overheads like administrative, selling and distribution overhead. In the case of trading account, we used to consider only direct expenses and direct overheads only, direct expenses only, whereas in the case of P&L account, we used to consider all other indirect and all administrative, selling and distribution expenses, and we will get a result that will be called as net profit or operating profit. Then the next one, after preparing the trading and P&L account, we have to prepare the balance sheet. A balance sheet is a statement prepared with a view to measure the financial position of the business on a certain fixed date. The financial position of the concern is indicated by its assets on a given date and its liabilities on that date. Excess of assets over liabilities represent the capital and is indicative of financial soundness of a company. It is a statement and not an account, and prepared from the real and personal accounts. So balance sheet is a statement showing the financial position of the business on a certain date, on a particular date. So that is why the title of the balance sheet will be balance sheet as on a particular date, or balance sheet as at a particular date. See, in order to show the financial position, we are required to record assets and liabilities of the business on that particular date. The excess of assets over liabilities represents capital, and indicates the financial soundness of the company. Balance sheet is only a statement, it is not an account. So that is why there will be no debit side and credit side. Instead of debit side and credit side, we can say liability side and asset side will be there. And balance sheet we used to prepare from the real and personal accounts, because we are required to record transactions related to assets and transactions related to liabilities only. So transactions related to assets we can say, asset side we can say real account, and see liability side we can say personal accounts. So this is the format of a trading account. Trading account for the year ended or year ending. Left hand side is debit and credit, see right hand side is credit. Particulars column amount, then particulars amount. So debit side we used to always record to opening stock, to purchases inner column, less returns if any, that will be deducted, and net purchases will be showing on the outer column. To wages, then we are required to record all the direct expenses and manufacturing expenses, like to wages, factory rent, factory lighting, coal, gas and water, freight, fuel and power, carriage inward or carriage on purchases or carriage, works manager's salary, excess duty and customs duty. Credit side, buy sales inner column, less returns if any, that will be deducted and showing on the credit side. That means net sales only on the credit side. Then one more item, by closing stock. Then we have to balance this trading account. So as a part of balancing, just check which side is more. In case credit side is more than debit side, it will be a profit. So we are that balancing figure we have to record here on the debit side. We used to write to gross profit carried down. This is a gross profit. Credit side is more than debit side. The shortage will be debited here. See, the deficit will be recorded here. We can say gross profit. In case debit side is more than credit side, that shortage will be treated as gross loss. That will be showing on the credit side. We can say by gross loss carried down. So this is the way in which we can prepare the trading account. You can see here opening stock and purchases is debited. Closing stock will be showing on the credit side. See, this is for just to indicate, just to record the actual material consumed. So we are required to record, see, actual material consumed only. Material consumed is equal to opening stock plus purchases minus closing stock. So opening stock is debited. Then again we are debiting purchases. That means addition. So opening stock plus purchases, and we are crediting closing stock. Closing stock is crediting, means that is deduction. So we can say material consumed is equal to opening stock plus purchases minus closing stock. So we can say only actual material consumed we used to record. So even though we are purchasing many goods, don't think that we are completely using and we can charge all the purchases during this period itself. So that is why, in order to reflect, in order to show the correct material consumed, we have to show, see, opening stock debit side, purchases debit side, and closing stock credit side. Then next one, the continuation of trading account, we can say profit and loss account. So this is the format sample of profit and loss account. We can say profit and loss account for the year ended or year ending. So we used to start with P&L account. I told you this is a continuation of trading account. So we used to start with the balancing figure of trading account. In case the credit side, so we can say gross profit, it will be showing on the credit side because it is a credit balance. We used to write by gross profit brought down. See, in case it is a debit balance, that means gross loss, it will be showing on the, because it is debit balance, you have to show on the debit side to gross loss brought down. The next important thing, so debit side, we are required to record all the expenses, indirect expenses like administration expenses, selling expenses, distribution expenses, financing expenses, and some expenses like depreciation. You can see his sample items. To office expenses, we can say administration expenses. To bad debts, salesman expenses, rent and taxes, telephone charges, postage, printing and stationery, commission, salaries, depreciation, discount, interest. So we can say shortly, we can say all the indirect expenses which are related to administration, selling, distribution, and financing expenses. And some expenses like depreciation, we are required to show on the debit side. And all other indirect incomes like discount received, rent received, interest received, commission received, it will be showing on the credit side. You can see by discount, this is discount received, by rent received, by interest received, by commission received. The next step, please see balance this account. Please check which side is more. We can see suppose credit side is more than debit side. We can say that is net profit. So that shortage will be showing on the debit side to net profit carried down. And in case debit side is more than credit side, see that will be a loss. So that shortage will be showing on the credit side. We can say right by net loss carried down. So this is the way in which we can prepare the PL account. This net profit or net loss that will be carried forward to the balance sheet. And the last one in final accounts, we can say balance sheet. So this is the format of a balance sheet. Balance sheet as on. The title will be balance sheet as on or as at, because this is on a particular day. So only liability side and asset side. This is only a statement, no debit side, no credit side. Liabilities amount, assets amount. All the liabilities will be showing on the liability side and all the assets will be showing on the asset side. You can see first one is capital, add net profit as per the PL account, add interest on capital, less drawings. Then that net figure will be showing on the outer column. See capital. Then long-term loans, debentures, sundry creditors, bank overdraft, bills payable. Then asset side, goodwill, land, building, motor vehicle, furniture and fixtures, plant and machinery, sundry debtors, investments, cash in hand, cash at bank, bills receivable, closing stock. One of the important feature of balance sheet is that it must tally. The liability side and asset side must be equal. Suppose there is 100 rupees assets, there will be 100 rupees liabilities also. Or 100 rupees liability, there will be equivalent 100 rupees assets also. So, one of the important feature of balance sheet, we can say it must tally. There will be no balancing figure. There is no balance. So these are the ways in which we can prepare the final accounts. See the one important note, all the direct or manufacturing expenses will be debited in the trading account. All administration, selling and distribution expenses will be debited in the PL account. All incomes and gains, indirect incomes and gains will be showing on the credit side of the PL account. Thank you for watching my channel. Please do not forget to subscribe our channel. Please click the bell icon near to the subscribe button. You will get notification when we upload new videos. Thank you.